Hey guys, this is Mary with QuickWin Bookkeeping. So I've been asked several times how to read and interpret the financial statements. We're talking about the profit and loss, the balance sheet, and the statement of cash flow. So I decided to create a quick little series to kind of go over each one of those statements and how to read them. So we're going to start with the balance sheet. One of the things to look at with the balance sheet is it's really just like a picture. Let's interpret like if you opened up your wallet and you took all the contents out of your wallet and you took a picture, right? What you're probably going to find is you're going to find your debit card, right? And you're going to find possibly some cash. You might also find a gift card or gift certificate, something like that. Those things right there represent what's considered your assets. Those are the things that you own. And then what else you're going to find in there probably is your credit card or credit cards, right? And let's just pretend, for the sake of this demonstration, that you open up and you find a little note in there that's reminding you about a bill that you owe. Maybe it's a dental bill or a medical bill or, I don't know, gas bill or whatever, right? Something that you owe money to. So those items actually represent your liabilities, the things that you owe. So we've already covered things that you own and things that you owe, right? And so those are two big pieces that you're going to find on your balance sheet. Now, going back to the scenario, if you take the amount of what you own and subtract the amount of what you owe, that tells you what your net worth is. And that's exactly what your balance sheet is also doing. It's showing you what your net worth in the business is as of a particular date. That's the whole point of doing the picture, right? Because it's that particular day, that's where it's at, right? I don't know, when you think about your wallet, what you have in cash might have right now, but will you still have it tomorrow? That can obviously change every day. So that's why it's always about the particular day. Why is this report important? Getting tongue-tied. So why is this report important? The reason is telling you not only what your net worth is, but it also helps you see the health of your business. It's one of three pieces that can tell you how well your business is doing, right? If your liabilities are higher than your assets, you're not doing great, because that means you're going to have a negative equity, which means your negative worth or your worth is negative. You don't want that. So that's one of the reasons why you want to keep an eye on those main numbers. If your equity or your net worth, your total equity, i.e. your net worth, is really low, then again, you might be doing okay, but you're not doing it maybe as well as you want to. It's all dependent on what level and where you're supposed to be as a business, the type of business you're running, things like that. And obviously the higher that number is, the better and the higher worth the value of the business is. Now, why you want to keep also an eye on this is you never know when you're going to need it, right? If you want to go, say you need to go get a loan, whether it's a business loan or you're wanting to buy assets and you want to be able to get a good loan with a good, decent credit rating, right? Or excuse me, not credit rating. More like if you're wanting to have a lower interest, sorry, brain fart there. But yeah, if you want to have a lower interest, right, then you need to have a better net worth. And that's going to show them that you know how, that shows the lender that you are making sure that you're keeping your liabilities lower than your assets and at a good rate and hopefully consistently, excuse me. So that's the other thing is going to show you, right? Some businesses like contractors, etc., when you go to different states to work, some states are actually, for them to even give you a license to work in their state, they're going to need to know your net worth. They're going to want to know that you are licensable. So the key thing to think about is that when you're looking at your balance sheet, here's how you break that down. Like I said, you've got things that you own. That's all of your assets. That's your checking and savings accounts. That's your any of your fixed assets, your accounts receivable, if you have those. So that, yeah, that's what you want to be looking for assets, right? And then the next thing is going to be your liabilities, and your liabilities can be, of course, your accounts payable if you pay vendors They send you an invoice and then you pay them later. That's your accounts payable, so you're paying that later. So those are liabilities. And then you've got loans, right? Like if you bought assets on a loan, then you've got loans payable. That's liabilities. If you got credit cards, when you're paying the credit card bill itself, that is a liability. Now the expenses that you've paid on it might not be a liability, those might be expenses, but the money that you owe to the credit card company, that's a liability. So with law firms, they have trust liabilities, right? So you have an IOLTA account and then you have your trust liabilities. Those should always match, and the whole point. So the representation of your assets is that is anything that can be turned into cash. And that's why your fixed assets, your accounts payable, your accounts receivable, not payable, your accounts receivable, any current assets, things that you've paid up front, things like that, those could easily be turned into cash, right? So that's why those are things owned. And then you subtract the things that you owe, which is all those liabilities, because the assets have to be able to pay off those liabilities, right? Like if you were trying to sell your business right now, that's what definitely by far those someone looking at buying your business would definitely be looking at that, right? So they want to know that your assets can definitely cover all those liabilities. So that's why it's really kind of an important statement to be keeping an eye on. Another aspect to think about, of course, on the balance sheet is actually going to be within the equity itself, and that is the owner or partner's investments and distributions, or owner draw. That's all kind of the same, but essentially what that is, that's representing either money that the owner is putting into the business or how much money is being taken out of the business. Those, of course, not on part of the P&L. So it's always good to keep an eye on those and make sure that they're not getting too high, because if you've taken more out, then it's going to decrease your asset. That does bring us actually into cash flow, because those definitely are items that change the cash flow. And a lot of business owners, I've noticed, don't really think about the cash flow aspect. They're so focused on the P&L that they don't think about the fact that there are things like your liabilities and your distributions that affect your your cash flow. And so those need to be monitored by watching your statement of cash flow. We will do that one on the next. Hey guys, just an extra piece here I forgot to drop in. Be sure to click the link below and subscribe if you want to follow through with the rest of the series. I look forward to seeing you then.
This video provides general information and guidance on reading and understanding reports. The methods and interpretations presented are not a substitute for professional expertise. The effectiveness of these methods may vary depending on the complexity and purpose of the report.